Yeah, many thanks, Özlem, for this very kind introduction. Well, I wasn't aware that I've participated in all of these conferences, but since you've checked, it must be true. The title of my presentation is quite long. I was asked to give an introductory talk on the theories of inflation. And since I guess by now I'm well above average age of the conference participants, I took the liberty to take a history of economic thought perspective on that. And what I want to do is I want to try to make sense from a post-Keynesian perspective of some of the observations which have been made in the context of the recent years, in the context of the COVID crisis, the war in Ukraine, the rise in inflation on the one hand, and the increase in profit shares on the other hand. All of you are well aware that Weber and Wasner in particular, but also other authors in this context have talked about profit-driven inflation, or Weber and Wasner about sellers' inflation, as a heterodox counterpoint to what in the mainstream is discussed as inflation due to aggregate excess demand, mainly driven by government expenditures, or even or from the monetarist view, on excess money supply-driven inflation. Underlying causes in the literature are manifold, so higher import prices, higher energy prices, higher markups of firms, lower labor force participation due to COVID, changes in the structure of demand, bottlenecks in the global value chains, and in the production of goods. Weber and Wasner, as you probably have read, have a three-stage explanation of that. So first, in the first stage, we see rising prices in systemically significant upstream sectors, which create windfall profits and then provide the impulse for further price hikes. To protect profit margins, downstream sectors then propagate or even amplify these price pressures. And only in the last stage, in their view, conflict comes in, namely when labor tries to defend the real wage against these increases in prices. So the question I was asking myself, how can we make sense of these stylized facts, so to speak, in a post-Keynesian framework? And what I did, as I said, I took a kind of history of economic thought perspective, and I do that in basically three steps. I first distinguish different strands in post-Keynesian theories of inflation, the Keynes, Caldor, Robinson, and Marglin tradition, and the Kaleckian, Rowthorne, and Dutt tradition. Then I will, based on that, have two different models in this Kaleckian, Rowthorne, Dutt tradition. And finally, I would like, at least from one of these perspectives, try to discuss the effects of imported energy price increases. So, again, let us start with Keynes. And again, many of you have studied Keynes and know that Keynes, in particular in his treatise on money, in the fundamental equations of the value of money, has made this distinction between income inflation, driven by changes in what he calls the rate of efficiency earnings, and profit inflation, which is driven by excess demand in the goods market, so the inequality of saving and investment. In the general theory, in chapter 21, he has picked up this idea, and here he talks about semi-inflation, which occurs when we have discontinuous changes or increases in the wage unit well below full employment. And then he talks about absolute and true inflation, which arises when effective demand increases at full employment. And then you get rising prices and rising money wages. In the Caldor-Robinson post-Keynesian growth theory tradition, this mechanism has been used in order to analyze and describe an adjustment of saving to investment in the long run, when capacities are fully utilized. In Caldor, initially, we even have full employment, but in Robinson, of course, not. So we have, in this sense, saving in this model as an adjustment process alongside with a redistribution of income towards the long-run growth equilibrium. Inflation as a permanent increase in the price level will only arise if one group involved will resist this redistribution. Caldor in 1959 is very clear on this. So inflation in the true sense in Caldor only arises if we have resistance in the system. Now, this is a way of presenting that in a simple framework, a simple textbook framework, where on the left-hand side of the upper part you have the inverse relationship of the rate of profit and the wage share. On the right-hand side you have the accumulation function and the saving rate. And you see that whenever investment exceeds saving, you have positive inflation as an adjustment process, while when investment falls short of saving, you get deflation as an adjustment process. We will only have a problem with that as soon as there is resistance in the system, and John Robinson was, I think, first to theorize that, talking about the inflation barrier which might arise as soon as workers are defending a minimum real wage rate, which in the model in which we don't have technical progress, no productivity growth, is equivalent to defending a minimum wage share. So you then have two targets in terms of the wage share, which translate into two targets with respect to the profit rate, which you see up there. The equilibrium adjustment process is therefore blocked. We get rising rates of inflation driven on the one hand by excess demand in the goods market, and on the other hand by workers trying to defend a minimum real wage rate or a minimum wage share. Robinson had used this idea already earlier in 1938 when she talks about currency devaluation-induced wage price spirals when it comes to the explanation of the German inflation in 22-23. Caldor has also used this approach. In his view, it's not workers defending a minimum real wage rate or a minimum wage share. It is rather workers' aspiration in sharing in rising profits, which provides the reason for this inflation barrier. In 1976, Caldor has argued that also this inflation barrier can also be given by rising commodity prices, which will then trigger a wage price spiral. So what you get here is rising rates of inflation, no equilibrium in the model. It is Marglin in 1984 who has provided an approach in order to reconcile these two distribution targets, so the one of the capitalist given by aggregate demand in the goods market, and the one by the workers given by, let's say, a minimum real wage rate. And his argument is that as long as wage inflation and both price inflation depend positively on the distance towards the relative targets, the respective targets, then we can derive as a kind of equilibrium, in inverted commas, an equilibrium in which both groups will not reach their targets, but we will see equilibrium inflation, and we will see as a result a wage share or a rate of profit in between those two targets. In this model, we don't have a paradox of costs like in the Kaleckian model, which I will show in a minute, and also the paradox of thrift, which is one of the key features of the Caldor-Robinson post-Keynesian model, is not generally valid anymore. Inflation expectations do not play a role in this approach. Now, if we take this approach in order to discuss an increase in energy prices, in imported energy prices, we could follow Harcourt, 2006, who in this chapter of his book has applied Marglin's model in order to explain the different stages of development in modern capitalism after World War II. And we could just use Harcourt's example for the effect of rising oil prices, which he has used for the transition from the golden age towards the neoliberal period of capitalism in the early mid-1970s. And what we see here is then that an increase in these oil prices, on the one hand, negatively affects aggregate demand, so our investment function shifts to the left. And on the other hand, it reduces the workers' target rate of profit because it increases the workers' target wage rate or target wage share in terms of domestic production. Workers want to cope with increasing imported energy costs. And what you get then, depending on the degree of shifting, is, one example is shown here, is that you get a lower rate of accumulation. You get a higher inflation, and you get, in this case here, a lower rate of profit, and therefore a higher wage share. The problem with this model is, you could also get other cases. I just used that as an example. You could also get other cases. The problem with this model is that you have to assume permanent normal utilization of capacities. And an increase in the workers' target wage share, or a decrease in the workers' target rate of profit, as you see here, will always have contractionary effects. So wage-led demand or wage-led growth are impossible. An increase in energy prices has no direct effect on firms' target profit shares or rates, and the indirect effect, as you see here, is negative. And again, inflation expectations are not touched. And what we want to explain, namely the rise in energy prices and the rise in profit share or rising profit rate, is impossible in this model. Let me therefore turn to the post-Kaleckian theory of inflation based on Kalecki, Rowthorne, and Dutt. The basic framework of Kalecki, I think, is well known. So you have flexible prices in the primary sector. You have markup pricing on unit variable cost in industry and services. Markup is determined by the degree of price competition, overhead cost, and bargaining power of trade unions. And the profit share, including overheads, and the wage share of direct labor are therefore determined by the markup, by the ratio of unit raw material cost to unit labor cost, and by the sectoral composition of our economy, because markups and profit shares may be different across sectors. In a simple open economy extension, you can assume that raw materials are imported and output competes in international markets. Domestic distribution then depends on the markup and the ratio between unit imported raw material cost and unit wage cost, and therefore the nominal exchange rate, foreign prices, and the domestic wage rate. A real devaluation, so a fall in nominal wages, a rise in foreign prices, or a nominal devaluation of the currency, raise the domestic profit share even with a constant markup. So this, please bear in mind when we go through the different approaches. In Kalecki, 71, it is clear that the increase in money wages may also have a direct effect on the markup, which leads him to claim that increases in money wages will, on the one hand, have a positive impact on the price level, but money wages or money wage increases are not completely shifted to consumers or to the goods market. So you see both. You see rising prices and rising real wages or a rising wage share. Soulos-Labini, in a paper in 1979, has, in a sense, specified the microeconomic conditions for that. And his main arguments are that you get that as soon as you allow for differentials in unit labor cost or unit labor cost growth within industries. which lead, in the case of rising nominal wages, only the most productive firm will fully pass rising nominal wages on to prices, while the competing firms will not be able to do so, and this then leads to a fall in the markup. And if nominal wages fall, the reverse happens. Only the least productive firm has to fully pass this fall in nominal wages onto prices, while the other firms, the more productive firms, don't, and therefore the average markup rises. If we now look into the Kaleckian inflation theory, we have basically two founding fathers. Usually they are, in all this review work which we have seen, they are mentioned together without focusing too much on the difference between them. And I would like to focus a bit more on the difference between the contributions by Rowthorne and by Dutt, because Rowthorne 1977 has a clear idea that inconsistent targets of workers and firms will lead to what he calls unanticipated inflation. And therefore, as soon as targets are incompatible, you will get accelerating inflation. He, in the further part of his paper, modifies this idea a bit, and he talks about regimes of low inflation and regimes of high inflation. And only in high inflation regimes you will see this accelerating inflation, because in these high inflation regimes, expected inflation will be fully passed through by workers in their wage demands, and that will then lead to rising rates of inflation. In low inflation regimes, inflation expectations do not feed into wage inflation, and this is the precondition in his paper to generate a Phillips curve. Dutt has criticized Marglin because of the full capacity utilization assumption, and provides a model in which you can get below full capacity equilibria, and that provides the condition for wage-led growth. Inconsistent targets in Dutt's model generate inflation and have an impact on equilibrium distribution. So in Dutt's model, a rise of workers' power leads to a higher wage share, higher inflation, and higher demand in a wage-led economy. So we will see a typical Phillips curve. While if capitalist power is falling, you will also see a higher wage share, but then you will see lower inflation and higher demand in a wage-led economy. So that's the opposite of a Phillips curve. However, in Dutt, we don't have the inclusion of inflation expectations, and I think that's the main difference with respect to Rowthorne's contribution. Therefore, if we look at the strands in basic post-Keynesian modeling of inflation, we can distinguish two. One is going back to Dutt, and we find that in the recent textbooks by Robert Blacker and Mark Setterfield, also in the different version of Mark Lavoie's textbook. There are also lots of papers on that. And the core feature of this approach is that we have no or incomplete effect of inflation expectations, which Mark and others call indexation, in the wage and price inflation equations. So in this, you get Dutt's results. So inconsistent claims, with inconsistent claims of workers and firms, you get constant inflation or deflation and distribution at any rate of employment. There is no inflation barrier in the Robinsonian sense anymore. If you have consistent claims, inflation will be zero. The other approach, which goes back to Rowthorne and which Engelbert Stocker and myself have picked up, and which you can also find in the work of Malcolm Sawyer. I hope my interpretation is right. Malcolm might want to correct me if not. You have adaptive expectations of workers in the wage inflation equation, and therefore you get inconsistent claims. You get that inconsistent claims generate unexpected inflation or disinflation, and also changes in distribution at any rate of employment deviating from the inflation barrier, something which I have called a stable inflation rate of employment, which is the opposite of what in the counterpart of the orthodox idea of a Nauru. However, as Engelbert has clearly spelled out in 2008, in this view, there is a Nauru at any point in time, but it's neither exogenous nor is it a strong attractor for actual employment. Only when we have consistent claims, we get a constant rate of inflation and constant income distribution. And this consistent claims equilibrium, so the sire or Nauru, is itself endogenous to aggregate demand and economic policies. I only have 5 minutes, okay, so I'm running out of time as expected. I will now, I don't bother you with this, I would now like to go through the effects of imported energy price increases in the context of at least one version of these models. And I will take the Blacker-Setterfield-Lavoie version. And I will do that in 4 steps. So I will look into the increase in imported energy prices and hence in the real exchange rate. I will then, in the second step, introduce firms that take advantage of the supply constraint and increase the markups. In the third step, I will then look at the effects of inflation targeting central banks, which drive up the long-term real interest rate. And finally, I will basically outline the basic post-Keynesian policy approach.
4 things in 4 minutes.
What?
4 things in 4 minutes.
4 things in 4 minutes. So we have an open economy here, and we look at an increase in energy prices, which leads, for the sake of the argument, to a permanent increase in the real exchange rate. We assume workers only buy from domestic firms. Firms' target profit share is affected by the real exchange rate, even with a constant markup, using Kalecki's profit equation. And we introduce, and we have a profit squeeze distribution curve as found, so which means that distribution, the wage share is positively associated with the rate of employment, and we have a wage-led demand and employment curve, which is positively affected by the real exchange rate. What we get now is a lower target wage share of firms. As a result, so a downward shift of this curve, we get a lower profit squeeze distribution curve. We get a shift of the employment curve to the right because if the real exchange rate is going up, it means that domestic firms are more price competitive, and the Phillips curve is shifting up as well. So what we get then is, as a new equilibrium, a lower wage share, lower employment, and a higher wage and price inflation. Now, if bottlenecks come on top of that, so now look at the green lines, I hope you can see the colors, it means that firms' target wage share curve shifts down even further, the profit squeeze distribution curve shifts down, the wage-led demand and employment curve shifts to the left, so we lose international price competitiveness, and the Phillips curve shifts up once again. So what we get as a result of that is even a lower wage share, a lower employment rate, and a higher wage and price inflation. If we now introduce inflation targeting central banks, so now look at the blue line, what you get is that the target wage share curve of firms shifts down because we have this interest cost channel. The profit squeeze distribution curve shifts down as well. Wage-led demand employment curve shifts to the left, assuming that a higher interest rate has negative effects on aggregate demand, and the Phillips curve shifts up even further. So as a result, you get lower employment, a lower wage share, lower inflation, but not necessarily down to the initial rate, which might require further interest rate hikes. So what you get is a further depression of the economy due to the central bank intervention. Now, how should an alternative policy approach look like? So the basic idea of an alternative policy approach would be to induce firms' target wage share to return to the initial equilibrium by lowering the aggregate markup according to the rise in this ratio of material cost to wage cost. For that purpose, we would need central bank policies which target a low long-term interest rate, We could tax extra profits, we could introduce price caps, we could, in the medium to long run, introduce competition policies, and we should introduce or make use of public investment to reduce bottlenecks. In this context, it is important to share the burden of a higher real exchange rate and stabilize domestic distribution. So workers' target wage share curve should, at least for a certain range, be aligned with what is possible by firms' pricing, which would make the Phillips curve at least partially horizontal. For this, we would need wage bargaining coordination, strong trade unions, employer associations, maybe government involvement. We would have a wage. We would try to, in the medium run, try to follow the post-Keynesian wage norm in order to make sure that wage setting is in line with a target rate of inflation. Fiscal policy demand management can then shift our employment curve to the right and make it consistent with or shift it to the right, which is still consistent with the target rate of inflation. Tax policies and social policies should reduce inequality and support lower-income households carrying the burden. This is, in a nutshell, the alternative policy approach based on our idea of coordinated macroeconomic policies. I'm running out of time, and therefore I will not present you the alternative approach, which provides you with basically the same figures, and the only difference is that you don't have an equilibrium position in between. You always have forces which drag the economy away from this intermediate equilibrium position. Forces which have to do, on the one hand, with changes in distribution, and which have to do, on the other hand, with real debt effects due to unexpected inflation. So let me just take one more minute, Özlem, and summarize what I wanted to say. So I think in my reading, there is broad agreement in post-Keynesian economics that the essence of inflation is always a distribution conflict, which can have different triggers. So in this sense, inflation is always and everywhere a conflict phenomenon. This distinction, which we see in the literature, also in the post-Keynesian literature, between demand pull, profit claims push, wage cost push, tax push, imported goods push, currency devaluation push inflation, can only relate to the trigger, not to the essence of inflation. I think that's important. I think there's also broad agreement that the pass-through of inflation is incomplete. There are a few exceptions, including myself, but these are papers which were dealing with the new consensus macroeconomics and were focusing on other features. My friend Hans-Jörg Herr may disagree about that, but well, he can mention that in the discussion. There's also a broad agreement on the required policy mix from post-Keynesian. So moderate distribution conflict by incomes policies, align wage share targets of workers and firms, and complement all that by low interest rate policies, functional finance fiscal policies, and redistribution policies. And we need international coordination in order to coordinate our inflation targets such that beggar thy neighbor policies, etc., are impossible. I have further conclusions which I will not go into because they are related to what are the differences between these two approaches. So we will write a paper about that. Maybe just for the younger generation, what do we need to do in further research? I think what we need to do is take a closer look at how exactly we are modeling the effect of the real exchange rate in our model. There are different approaches in the literature. And we should focus more on sectoral approaches, because what I did here in that work is I used the real exchange rate as representing changes in energy prices. There's an interesting paper by Raphael Wildauer with co-authors, which will be presented here in this conference where you have a three-sector model which has a more differentiated view on that. Finally, I've shown that correlation of rising inflation and rising profit shares are possible in our post-Keynesian Kaleckian model. It may be due to the rise of material to the ratio of material to wage costs, or to rising markups, and also to other factors, and I'm sure that Mark will go into that. Many thanks, and apologies for using extra time.